Good morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. Here we are starting November. The equity market uptrend still continues, so let's talk about this a little bit. We compared this correction that we saw this year a little bit back to 2011, and right about this time in 2011, the market, the S&P and NASDAQ got above its 200-day moving average and reversed. So far, over the last 2 weeks, we have not seen that this year, so the market's acting pretty well. Now, what we are looking for is to see if the S&P, if it does pull back, as long as it maintains that 2060 level, that coincides with its 200-day moving average, and the next level of support would be the 2020 level. That coincides to its September peak this year. Now, on the NASDAQ, we're looking to see if it holds at 4960. Actually, it's well above that, the 5,000 level now. May test that 5100 level this morning, to be seen as the markets are rallying this morning. So on the downside, we're looking at 4960 and the 4933 level. And of course, the 4800 below that. But of course, any of those levels, NASDAQ still stays above that. This uptrend is still intact. Now, the one negative thing that we're seeing is divergence is the small caps. The small caps are not participating in this rally. And that pretty much tells you that the market may be risk off. All the money's flowing into the large caps, as we see, as I mentioned last week, the NASDAQ 100, pretty much near highs. And of course, if we look at the S&P 500 versus an equal weighted S&P 500, the S&P 500 regular that weighs the large cap stocks a little bit more is outperforming. So we'd like to see a little bit of participation from the smaller companies. And if we do start to see that, that's really going to tell us that this rally truly has some legs. But there are a few other things that are also telling us that this rally has legs. Specifically, we look at the technology sector, which is an aggressive sector. That's at an all-time high. So if you look at that ETF, XLK, you'll see that. And also what we see is the XLY, which is the consumer discretionary, outperforming the XLP, which is the consumer staples. Whenever you see that situation where the non-defensive sectors outperform the defensive, meaning consumer staples are viewed as defensive, that's a really good sign for the market going forward too. We have a rising bond yield. That's very good for the market as well. And pretty much the market took the clue from the Fed, the last Fed statement, that the Fed sees the economy improving a little bit. And so we saw the staples trade down, and we saw utilities trade down. So whenever you see the sort of staples or defensive doing not so well, but the other sectors doing well, the aggressive sectors, that's a good sign for the market. Now, the one sector that was kind of a strong sector all year has been healthcare, XLV, biotechnology. It's in that space, and that sort of fell off. But however, we are seeing a rebound in that space. So I'd keep an eye on that, and that also will add fuel to the rally. Now, one of the stocks that we're keep accumulating, you've probably heard me mention this before, is Gilead Sciences. The symbol is GILD. Basically, they're a leader in the hepatitis C market, the HIV market, hepatitis B, and NASH, which is a non-alcoholic fatty liver disease. So those are the things they're working on, actually, the hepatitis B and the NASH. They still haven't brought drugs to the market, but those are the things they're working at. But they are the leader in the HCV market. And just to give you an idea of how much money they're making, basically in 2013, they made about $2 a share. In 2014, they made $8 a share. And they're projected to make $12.09 a share in 2015. And that may still be actually an understatement. And actually that changed. It was about $11.50 analysts were expecting. But last quarter, when they blew away estimates, all the analysts raised their price targets. So basically, they raised the price targets, but yet Gilead has not traded away. It's basically trading very cheap. It's trading at a forward multiple of about 9. The market doesn't believe that Gilead can grow anymore, meaning the idea is that their HCV drug's working so well that it's curing everybody and they'll have no more patients. Well, that's a little bit ridiculous, but anyways, just to give you an idea, hepatitis C is viewed at this time that there's about 4 million people in the U.S. that have it. Gilead thinks that they can maybe treat 250,000 people a year. So you do the math, you got 10 plus years of patients there. It is an infectious disease, there'll be new cases. And of course, we don't even add in worldwide how many people are HCV, they're treating them in Europe. They just got an approval in Japan, and of course, they're trying to make inroads into China. Now, Gilead has about $25 billion in cash. They started issuing a dividend. They have a buyback program. And so far, last quarter, they only spent about $3 billion of a $15 billion buyback program. Their average cost was about $110 a share. So even the company thinks at those prices it's cheap. Now, right now, Gilead's trading at about $109. We've been basically buyers of Gilead anywhere from $63 to about $118. We've traded in and out of it, but it seems to have really strong support in the 100 to 95 level. If it trades anywhere in the low 100s, that may be a great time to pick it up. It's a great time to pick it up here. I think the company will continue to grow. This month, there's a big liver conference in San Francisco where Gilead has submitted 70 abstracts that have been accepted to be presented at this thing. So we might find out some more news about some of their more HIV treatments, about some of their phase 3 trials in hepatitis B. So there's a lot looking forward to, and of course still their HCV franchise. Now they also took out a $10 billion loan. So the street's speculating that they're probably going to buy someone to bring more product into their pipeline. That would be welcome. That's perhaps why the market is sort of not really running Gilead up. They want to see them buy another company, see some more drugs in their pipeline. So it's a lot to talk about here. I don't want to get into all the details of all their drugs. There's a lot going on there. You might want to check with your financial advisor if this trades for you. But basically, here's a company who is just printing cash, $30 billion a year in revenues, 88 to 90% gross profit margins, and I believe they're probably going to exceed that $30 billion because they've already come in at $23.7 billion this year. 1 quarter to go, that's only about $6 billion. Over the last few quarters, they've been coming in over $7 billion. Last quarter, $8.3 billion revenues. So it's to be seen. It could be exciting. And of course, I think the stock's very cheap. But I'll say it again, consult your financial advisor to see if this trades for you. So as always, let price and volume be your guide. This is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. Have a great trading week.